You did everything right. You listened to the titans of finance who told you the secret to long-term wealth was simple: just buy the market. So you put your hard-earned money into low-cost S&P 500 index funds, trusting that slow, steady march of progress. And for years, that was a brilliant, effective strategy. But what if the very foundation of that strategy is cracking? What if the safe investment you've been relying on is quietly becoming one of the riskiest bets you can make? Right now, the market is flashing red signals, hitting valuation levels that have historically come right before major crashes. Now, this isn't about fear-mongering. It's about being a smart, informed investor. We're not here to tell you to sell everything and run for the hills. We're going to give you the data, show you the 3 critical dangers hiding in plain sight within your portfolio, and lay out a clear, actionable plan to protect your wealth before it's too late. Number 1. The valuation time bomb. The first and most glaring red flag is that the U.S. stock market is historically dangerously expensive. We can measure this in a few ways, but 2 of the most reliable indicators are screaming a warning. First up is the Shiller P/E ratio, also known as the CAPE ratio. Think of it as a price-to-earnings ratio for the whole market, but smoothed out over 10 years to avoid short-term noise. The long-term average for this ratio is around 17. Lately, it's been hovering at levels near its historic highs. To put that in perspective, the only other times in modern history we've seen valuations this stretched were in 1929, right before the Great Depression, and in late 1999, just before the dot-com bubble burst. If that's not sobering enough, let's look at what Warren Buffett calls probably the best single measure of where valuations stand at any given moment. It's the Buffett indicator. It compares the total value of the stock market to the country's economic output, or GDP. A ratio of 100% is considered fair value. Today, the indicator is deep into what is considered significantly overvalued. Some models based on this indicator predict that from these levels, future annual returns could be close to 0 or even negative over the next decade. So what does this mean for you? It's simple. The tailwind of expanding valuations that pushed your index fund higher for years is gone. It's a headwind now. You're paying a premium price for assets, which mathematically limits how much they can grow in the future. Buying the S&P 500 today isn't just a bet on the American economy, it's a bet that these bubble-level valuations can last forever. History shows that's a losing bet. Number 2. The illusion of diversification. The second huge problem is your index fund isn't nearly as diversified as you think. You think you're buying a piece of 500 of America's greatest companies, spreading your risk. In reality, that's not what's happening, because the S&P 500 is market cap weighted. The biggest companies take up the biggest pie of the pie. And right now, that concentration has reached an extreme. As of early 2026, the top 10 stocks in the S&P 500 make up a massive chunk of the entire index, around a third of it. The so-called Magnificent 7 tech stocks alone account for well over a quarter of your investment. Think about that. About 1/3 of your diversified fund is tied to the fate of just 10 companies. That's not diversification. It's a highly concentrated bet on a handful of mega-cap tech stocks. It's like loading all your most valuable cargo onto one side of a ship. As long as that side is rising, you feel great, but if that one side starts to take on water, the whole ship is at risk. This extreme concentration means 2 things. First, your returns are now chained to the performance of just a few big names, which defeats the whole purpose of buying a broad index. Second, you're being forced to buy more and more of these stocks as their prices go up, effectively making you buy high. When you put new money into an S&P 500 fund today, the lion's share isn't spread evenly. It goes straight into the most expensive, most crowded stocks on the market. It's the exact opposite of smart investing, a built-in system for buying high and selling low. While each instance is small, these little frictions, along with things like cash drag, add up over time and can silently chip away at your returns over the years. You're essentially paying a hidden tax for the fund's rigid structure. Okay, that was a lot of bad news, but understanding the problem is the first step to fixing it. If you're finding this breakdown useful and want to stay ahead of these market shifts, take a second to subscribe and hit that notification bell. Our goal here is to give you the clear, data-driven insights you won't get from mainstream finance, and we release deep dives like this every week. The solution: 3 ways to fortify your portfolio. Now for the good news. You don't have to ditch your entire strategy. You just need to upgrade it. Think of it as evolving from a passive investor to a strategic one. Here are 3 concrete ways you can fortify your portfolio against these risks using low-cost ETFs you can buy today. Solution number 1. Reclaim your diversification with equal weight. The most direct fix for the concentration problem is to switch from market cap to equal weight strategy. The Invesco S&P 500 Equal Weight ETF, ticker RSP, invests in the exact same 500 companies, but instead of letting the top 10 dominate, it gives each company an equal 0.2% weighting. This immediately solves the concentration risk and gives you true diversification. Historically, this strategy of not being overweighted in the biggest names has performed very well, especially in markets that aren't being led by just a handful of stocks. Solution number 2. Hunt for bargains with value investing. While the mega-cap growth stocks are trading at nosebleed prices, a whole segment of the market has been left behind: value stocks. These are solid, profitable companies that are simply trading at a discount. They have lower PE ratios and often pay higher dividends. In an environment where the overall market is stretched, hunting for these bargains is a time-tested strategy. You can do this easily with an ETF like the Vanguard Value ETF, ticker VTV. This fund screens for large-cap companies that are considered undervalued. In a market fixated on growth at any price, focusing on value can be a powerful and profitable move. Solution number 3. Think small for bigger returns. For the last several years, all the attention has gone to the biggest companies on the planet. This has left smaller companies, or small caps, in the dust. As a result, small-cap stocks are now trading at a significant discount to their large-cap peers. Smart investors are starting to rotate into this unloved sector, recognizing the potential. Consider adding an ETF like the Schwab US Small Cap ETF, ticker SCH. For those who want to combine this with the value factor, the Vanguard Small Cap Value ETF, ticker VBR, is an excellent option. Adding a small cap allocation diversifies you away from the mega cap mania and positions you in a part of the market that is cheaper and has more room to run. Let me be clear, index funds aren't evil. For a long time, they've been an incredible tool that helped millions of people build wealth. But market conditions change. The strategy that was a sure thing for the last decade isn't guaranteed to work for the next one. Today, blindly buying a market cap-weighted index fund means you're making a concentrated bet on some of the most expensive stocks in history, all while the market is flashing major warnings. Being a smart investor means recognizing when the game has changed. It means understanding the risks hiding just beneath the surface of your own portfolio. The goal isn't to panic or abandon a strategy that has served you well. It's to evolve. By adding strategies that target equal weighting, value, and small cap to your core holdings, you can build a more resilient, truly diversified portfolio that's better prepared for whatever comes next. Don't just trust the market, understand it, and position yourself to win. What are you doing to adjust your portfolio for this new environment? Let me know in the comments below.